again for putting this extravaganza together, as well as inviting me to the extravaganza. You know, Thanksgiving, we're getting so close. It's you know, you got to spend some time being thankful for the opportunities that that trading gives us as traders. Even though you may not be winning, because the opportunity is there, and by not winning, somehow you're not taking advantage of the opportunity. And the truth is that really 1 or 1.5 out of 10 will take advantage of the opportunity of trading on a consistent basis. But what puts you in that top 10% to be a consistently winning trader is very doable. You just have to make a commitment, and I believe in the beginning have a mentor to help you through, especially the emotional part, which most mentors, I guess I'm going to include myself as a mentor. I've been accused of that. Most mentors really don't have much of a sense of the mental part. They'll just say, hey, if you just follow the trading plan, you'll be okay. But again, that's turning away from what's going on, and that's exercising old habits, whether it's trading old habits or personalized old habits in your trading. In any event, I'm going to be alluding to the mental part along the way, but today is more of a structural presentation, and it's going to key on the 6 keys to defending open trade equity. Those that know me know that in the last few years, I've been focusing solely on helping traders to get funded and get paid by the prop firm that they're funded with. Apex and Top Step are the 2 that I always refer to because they're the biggest. They've been around the longest. I think they're, and for other reasons, they're the best. And both, as well as other prop trading firms, they focus on futures. About 90+% of prop trading firms where you get to trade somebody else's money and get, in the case of, say, Apex, 90% of the profit you generate. And you wonder, how can they do that? The answer is they're asking you to pay some very small fees, and I'm talking about $30 a month to qualify for a $50,000 account. That's not a lot of money when you get funded and have the opportunity to get 90% of what you're trading. But I'm going to assume that many of you have either considered and looked into it or currently prop trading. The question of open trade equity is a major question, and one that professional traders have focused on for years, defending open trade equity. But newly anointed prop traders who have been trading their own money in their own way, in a private way, don't really respect as much as you should. In fact, Apex and others, they hold lost open trade equity against you. I'm going to be referring likely to a $50,000 account with Apex in my examples, but defending open trade equity holds in any kind of trading, whether it's prop trading and the like. But prop trading kind of forces you to do what professionals have been doing all along. Some may consider it's a negative. It's not a negative if you're a professional trader. Professional traders don't create a $1,000 open trade profit in a $50,000 account, 2%, and then let that go and make it okay to be break even. You know, in your own account, if you do that and you're even, you say to yourself, well, I really didn't lose any money, but I really should have taken that 1,000 that I had. Prop trading is not that forgiving. And so let's get into defending open trade equity, that red line that you need to avoid in order to keep your trading pleasant and actually enjoyable. If you're not enjoying your trading, you need to make some changes. And in prop trading, stay away from that red line. In a $50,000 account with Apex, you $47,500 or $2,500 is all that you're allowed to slip from any open trade high that you've had. Won't get into those numbers right now, but I'm focusing this presentation on those that are considering prop trading and those that are currently struggling in prop trading or successful and want to improve. I'm going to give you 6 keys to defending open trade equity. First thing, well, a little about me. If you don't know, I graduated from the University of Cincinnati. Go Bearcats. I did spend some time in the restaurant and nightclub business, running the Prime Studio 54's main competition, which really never happened. The clubs really never succeeded in that respect, but they were high-end disco type clubs, and it was fun. But I decided to use my math degree for something that I enjoyed even more, and that was trading. Within about a year and a half of getting in the business, I was running one of the largest option firms in the country. Now, this is kind of a picture of what it looked like. I had 63 traders under me in the home office. Kind of looked like this. This is not an exact picture. I couldn't find one. I don't have one, but this is, I want to give you kind of a taste of what it looked like. And what I noticed about these traders, I was responsible for making sure that they were as profitable as they can be for their clients. And this is where I learned about how to build and run trading plans. Those that were doing well, the trading plans were simple and were easy to react to. Those that seemed to be struggling and having trouble getting into trades and etc., were traders that had too many hoops to jump through. And so this is where I learned. I would call them into my office if they were on the bottom of the tote board for their clients, and I would literally have my red pen out, erasing areas that were redundant. Why have an MACD when you can always, and an RSI? You don't need 2 momentum indicators. Pick one. And I'll get a little into that in a second, a little bit more. But after a while, they were buying out professionals in the business, and Payne Weber gave me a good offer. I went with them as a commodity trading CTA, a commodity trading advisor, where I was running millions for clients that trusted Payne Weber with their money, and did very well. In fact, I was making 20% of the profit that I generated in the money that I was trading. That's what commodity trading advisors get. It's not, but not 90%. Of course, I was trading a lot more money, so 20% represented a much bigger number. But still, without being a professional trader, you can actually be paid like one, getting 90% of 50, 500. I mean, as you get into it, you're going to likely easily be trading at least $500,000 and more. Okay, that experience that I mentioned with the option firm and with Payne Weber had me. I became kind of the guy that wrote trading plans for professional traders. I've written several books. This is one that's still available on constructing and running effective trading plans, as well as trading. Because of my animated style, I think in some of the expos when I'm on stage, I've had books talking about some of the things that I say. So I've been around, and I'd like to help you to be successful with your prop trading by helping you with these techniques about capturing open trade equity. Not letting it slip through your hands. The disciplined trader has been around since 2000, where we concentrated on the mental and emotional piece for the first 15 years of the organization, and so we still have a love for that. Can help you that. There's probably not a trader I've helped in the last couple of years with the technical part of trading that I didn't throw in and help them a little bit about the mental, because that's really where the rubber meets the road, on the mental part of trading. My most recent effort is Their Money Your Profit, which will be a site that will focus essentially on this. I'm writing a book. I'll tell you a little bit more about that later. So let's get into it. I'm looking at the chat real fast and seeing, oh, that's just stuff about me. All right. let's get going with the, well, first I wanted to tell you that if you're going to go with Apex, and that's eventually somebody will ask, who do I trade through? And I trade now through Apex. So even though I have traded with Top Step, I'm now with Apex, and I've done some of that mental and emotional work for Apex, some of their traders. And so this is a link that will always lead you to Apex's best advertised or unadvertised special. I mentioned that in a $50,000 account, that the cost for every month of trying to earn $3,000 on a $50,000 account, it likely won't take you more than a week or two, if that. In any event, those fees, the small fees that are involved, you'll always get your best deal when you open an account using this link. It always forwards to their best deal. So I wanted to show it to you. You can write it down, take a pic of it before we get started. Okay, let's get into it. The first key to preserving open trade equity is having a frequent, reliable A+ trigger. The previous video that we saw mentioned A+ triggers. A+ triggers to me are those that are frequent and that they are reliable. When I say let's say an A+ trigger is tested to jumpstart with a pop. That's important to me. When you have a trigger that pops when applied, in other words, you get your signal to get into a trade, you apply the trade, you execute the trade, the next couple of candles, and I use candle charts, the next couple of candles should result in a pop. And when I say should, I mean that it is attested to jumpstart. In other words, I know from testing this trigger, an A+ trigger, that somewhere in the neighborhood of somewhere from about 65 to 72%, that area, you will get that pop. The importance of that pop is to take a quick profit from a scalp. Now, I was never a majority scalper, and I'm still not, but half of what I do in prop trading now is scalping. And why do I do that? Why do I suggest that you do that? It's because it immediately captures that initial open trade equity that is given to you by using a frequent, reliable trigger, one that pops. You can get that 2/3 of the time you put it on, you're going to get a pop in the first couple of candles, and that will give you enough to take a really nice profit, and really nice open trade equity profit on it. And I'm going to explain a little bit more about that in a second, the use of it, but I just want you to understand that when you have a trigger that jump starts, that's part of the A+ definition for me in prop trading. You've got a trigger that you want to rely on. Many benefits. You get scalping opportunities, and you're not starting from a deficit. Again, in the mental game of trading, if you do apply a couple of contracts in the futures market, and the market gives you that nice pop because you're using an A+ trigger, you can take out half of what you've got on. If you put on 2, you can take out 1 and capture, let the other one do something different. I'm going to show you what I like to do in a second. But again, a tested to jumpstart with a pop, that's part of the A+ definition. Frequent reliability means that it works 67 to 7. Actually, in more recent tests, I'm looking at more like 65 to 72. So it's widened, and the difference when you apply a frequent reliable trigger, why sometimes 67 and why 70 in my example here, it's because of the environment that the trigger is in. That has nothing to do with whether you take the trade or not. Taking the trade relies on certain simple parameters. The strength of the trade, how many contracts you put on, the exposure that you want, really is a matter of the environment. For instance, if you're putting on a long trade, if you get the trigger for a long trade, and that's coming off a double bottom, that is a very positive environment, you can expect more like the 72% or more on the reliability of the trigger to give you a pop, okay? These are very high figures. Anybody that goes much higher than this, goes to 80, 90%, you really need to question that and ask where you know, how long the test was and exactly how they tested it. Testing testing trading plans is a labor of love. There are a lot of things to consider, especially some of the more complicated trading plans that I've seen. They're really almost impossible to test, which is why I like a simple trading plan, because not only are they more effective from a mental standpoint and a performance standpoint, but they have a high probability of winning. All right, you'll pull the trigger with confidence. There'll be no hesitating when you use a reliable trigger. If you're losing right now in your trading, or you're struggling, you're around break even and just spending a lot of time to get nowhere, these are really habits that are created through your trading, through your trading experience, and really losing becomes a habit, and winning and struggling becomes a habit. It's always my goal when I coach a new trader to change that habit, because if you don't admit that you're in a losing habit, you can change your trading plan but still lose, doing a whole bunch of different things in your trading. That's the reflection of a losing habit. It's not your fault. It's based on poor habits being emphasized and repeated, and therefore it should be recognized and easily corrected, incidentally, with the right tools. And we have all the right tools to do that. I always supply that for those that I'm working with on a trading plan. And we have a simple trading plan called Loaded Gun that's, I'm sure you've heard of. It's getting all kinds of stellar reviews the last few years, and it's just getting stronger and stronger. But when you have a trading plan that works, and you have somebody who you're accountable to, especially, then you are forcing yourself to get into better and good habits. When you start to actually make money performing the good habits, then you're on your way to developing the habit of winning, which is just as tough to break as the habits of losing. Okay, so I just want to tell you that there is hope for you, and in fact, there's a glaring, shining light type of hope, especially in the markets that I believe that we're about to experience in the next few months and all of next year. Okay, a frequent trigger is important. Reliable is important. Frequent is important because patience is probably the one area that, when we were doing strictly the mental game with our Discipline Trader Mastery Program, which of course we still offer, our sessions on patience, developing patience, was the #1 testimonial that we received. In other words, we had more testimonials on people who turned around the issue of lack of patience to patience of a saint, or ice in the blood, ice in the veins patient. When you're patient, that is part and parcel to better focus, and focus is a singular golden key to trading success. So a frequent, reliable trigger, you really want one. If you don't have one, get one, or take mine. We've got a couple of them that I think you do well with. In any event, the key #2 is take at least 2 contracts upon entrance. I'm a twin, so I can put that picture up. That's not me and my brother, but I am a twin, so I threw that picture in. But to impress on you that I really would like you to consider taking on at least 2 contracts with every trigger that is acted upon. By taking 2 contracts, you can treat one as a scalp and one as what I call a runner. Look, we are all here. We're here to make a consistent profit. But the more you trade, the more you see the opportunity for a considerable gain in a trade. In other words, you can see a magnificent runner making a lot of money on just one trade because you got it right. Some explosive things happen. You kind of want to be in there for. Scalping is great, and scalping, I believe, is necessary and a key to prop trading consistent performance. But you also want, you know, if you scalpers are always looking at what they didn't get from the position if they had stayed in. Those that look for the home runs all the time, they're all always looking at what they should have taken and didn't because they were looking for more. So there's always the question of, should I stay in? Should I not stay in? Now that I got a trigger that gives me a nice jump start. I got a nice, what should I do? Should I stay in for? Do both. This is what I'm saying. If you have both, it eliminates the question of what should I do? Okay, the more you have all of your decisions settled up front, the more you can focus and make it happen and make your trading enjoyable, but more importantly, profitable. Okay, one contract is for scalping. The first thing that it does, of course, is minimize the drawdown. Sure, if that second position that you have loses, you've minimized whatever drawdown. But I like to put in a stop at break even when I take my scalp. So if I have two contracts on in say the euro dollar or the mini crude oil contract, QM, if you're not trading the QM contracts, it's terrific, I think, for prop traders. I'll take the profit on one based on my scalping opportunity that I got because I'm using a frequent reliable trigger. And then I will move my stop to break even to the runner position. By doing that, I've locked in, I've padded my distance from the red line, but I also have the opportunity to make a considerable trade, something that could really put me in good shape. So the benefit too, of course, is capitalizing on the jumpstart trigger. There's a lot of things that you can do that you can't do when you have a tested jumpstart type of a trigger, okay? So minimizing drawdown, capitalizing on a jumpstart trigger. Now you have the other contract is for expansion, okay? I call it a runner, okay? The benefit, of course, is the opportunity for a big winner. I mean, I don't know any, you know, I mean, if you tell me that you don't want to, you know, you're not there to give yourself the opportunity for a nice fat trade, it's hard for me to believe you. There's a piece of you that wants that, and it's that piece that doesn't get satisfied that has you doing things you shouldn't do. So this kind of trading, when you take your scalp and pad your distance from the red line, and also give yourself a chance for a running, a nice big profit, you're satisfying both urges, and you're doing the right thing, and you're maximizing your profit opportunities. You got to defend against the growing profit. Let's talk just a little bit about the runner. Now, I'm not giving you a chart in this phase because I want you to focus on what I'm saying here. When you have a runner that starts to run, there's a point at which you need to defend more and more closely that open trade equity, because when you have a big runner and you take it, boy, does that help your distance from the red line. So you can do it with average, with mediocre results, not because you're trading mediocre, but the market is going sideways mostly that day. You can do very well with the scalping part of the technique. But when you have volatility in the market, this area is really one. But volatility by definition means big move one way and a reversal, big move the other way, with almost an unsure nature involved in it. So when you have that growing profit, when you have an open trade equity that's reasonable, especially at points where where you've just passed in a long trade, where you've just passed a recent high, which would be a resistance area. When you break through that resistance area and you really get some motion in your trade, in your direction, that's the time where you need to really start defending it, because you don't want that open trade equity come all the way back down. That's hurtful. So there's a number of things you can do. And the two things that I like to do, I like to do many things. The more things that in your toolbox, the better. But the obvious things is to move to a lower time frame. Okay, usually the same parameters. When if you move to a lower time frame, you're going to get more frequent triggers. In this case, more of a chance to take your profit at a point where it looks like it may be turning back in a direction that you don't want it. So a lower time frame and taking your signals off that can be helpful. In general, you know, there's the average trade indicator that I find can give away too much in a volatile market. I like the simple way of using a stop. I look at the two candles previous to the candle that I'm looking at that's active, and I like to put my stop below the low of those two previous candles. That gives me a little bit of room, but it also doesn't allow me to give up too much if it expands. So not the first candle, but not the first candle back, but two candles back gives me a little bit more. Anyway, I just wanted to bring that to you. It's a little extra for you, no charge. Again, minimizes drawdown when you protect that. And again, the primary benefit I can't stress this enough, is the common dilemma, the mental dilemma of should I scalp or should I run? Should I take this pop that I just got, this initial move, and just, my mother used to say, take what God gives you. You know, don't be greedy. Take what God gives you. I think she was talking about, she knew I would be a futures trader, I think, when she said that. Somehow she knew. But take what God gives you with the scalp, but also give yourself the opportunity with the runner. And with the process that I'm talking to you about, with taking at least two contracts, it really does minimize the mental part and can make your trading, like I said, actually enjoyable. Amazing. All right, let's go to key number three. Key number three is to take smaller contracts and give yourself a wider range to execute those contracts. Because you always have a choice of when the getting is good, and when I say the getting is good, when you see a divergence in the RSI, when you see a market that made a top and then retraced and then attempted that top again and took that top out slightly, but your RSI actually decreased, the momentum decreased, even though you made a new high the second time around. That is a very negative indicator. And so that's an environment where you want to take on maybe an extra contract, because when you get your trigger to go short, you've got a surrounding environment in what I've explained with the double top and the RSI to take advantage of a situation. You've got your frequent reliable trigger that works literally, and it can work almost in any environment. And now you have an environment that's positive. Hey, this is the time to take on possibly smaller contracts, many of them, but give yourself a wider range in a volatile market. Okay, so if the market is volatile, you want to take smaller contracts rather than taking on too many positions and having a closer stop. In a volatile market, and a market where you see great opportunity, give yourself more space. And to do that, you want to take smaller contracts and a smaller number of contracts and give yourself a small number of contracts and give yourself more space. I think you understand what I'm saying. I hope I didn't confuse you there. So the current market volatility demands allowing a position to breathe. Okay, it prevents whipsaws. Whipsaw, and we're going to talk about that a little bit more in a second. But when you give yourself more breath, and you can do that by exposing fewer number of positions, then you can withstand the whipsaw. Smaller contracts allow more contracts to be initiated to scale out of, which is another big benefit. Again, when you're defending open trade equity, and I believe in putting on all of my contracts for the effort for the trade up front, right in the beginning. That flies in the face of a lot of individuals who would rather see more and more confirmation in the trade before putting on more positions. I've never believed in that, and I've been on stage arguing about that. But I do believe that that if you have a frequent, reliable trigger, which most traders are not, don't test enough and haven't identified enough of them to do it. But if you have it, why not take advantage of knowing that the vast majority of the time you're going to get a pop, and take advantage of what you have. So I believe in putting on all your trading, your contracts up front, taking the scalp on half of those numbers of contracts, and then managing the rest. Because when you have a pop in a trigger and the market starts to move, especially counter to a trend or in a continuation after a correction in a trend, you may have some legs, and if you have legs, that could really mean a lot for the runner position. Okay, so smaller contracts allow more contracts to be initiated and scaled out of. So where do you scale out of them? I'm going to show you in a second, but it's also another defense against a drawdown by saving open trade equity. Here's an example in other words, you have a downtrend here, and in a downtrend, you've got lower highs and lower lows. Okay, and so, but when a market turns, and this is a trigger that I like to use, we use some moving averages. I'm not showing them here, but what I wanted to stress here is that if this were a trigger, and you got in here with, say, 3 contracts, 3 micros. If you have 6 micros, maybe you want to treat them as 2, 2, and 2. Okay, so don't like to divide them into 2 smaller parts, but let's say you take on 6 micros, and this is a 5-minute candle chart in the S&P contract. So S&P micros, okay? So you take 6 here. So where do you scale it? Now, in this particular case, our first scalp in this kind of a formation would be right around here. So you would take your first contract right here. It happens to be also right by the most recent high of the Dow trend action of the waves. And this is your first resistance. This is your second resistance here. This is your third resistance here. Right before, you never want to try to get the whole thing. You want to you want to put you notice that these arrows are just a little bit below, maybe 20% below. You want to make sure that you're going to take your scalp if you're going to do this, and you want to put in your limit orders. So the idea here is that if you take your first 2 out of 6 positions out here, and if the market continues, you can see how the market went a little bit sideways here, right, at this juncture, and now it popped again. Here's where you would be taking your second position. You'd have your limit order. You take out your profit from the second 2 micro positions out of the 6, and you'd have the other one here. Well, the market didn't give you that opportunity, right? So at some point here, and as you're managing, you would be getting out in our position, we'd be getting out in this area. But the idea is that you want to define the stages at which you want to take your profit on your runner. Okay, this would be the first area that you would be taking your first scalp, but then you need a process to peel off if you have multiple positions on with the runner and you're not using the 2 bars back and that kind of thing that hasn't really broke it out, essentially. In any event, I just wanted to suggest to you this is the obvious way. This is from Trading 101, but it's Trading 101 for a reason, and that's because these techniques work. And again, the mistake traders make is they want too much out. They'll look at the high here and they'll put their limit in 1 or 2 ticks below. No, put it in 10 ticks below. Put it in you want that, you want to capture that. And so don't fool around with the highs. Don't be greedy. Ask my mother, she'll tell you that. All right, that's the key number 4. Let's see how much time I have left. I got about a half hour. That should be not quite what I need. But the key number 4 is limit the time you spend trading. This is important. The less time you have to trade, the more that you'll focus on following your trading plan. I'm going to let that sit there. Whenever I have a new trader that I coach, and I can only trade, 60 minutes or 90 minutes out of the day, or I can only trade from this time to this time. My response is great. It's fabulous. I find that traders who trade all day, if you're not a professional trader in a winning habit, this just gives you more opportunity to struggle and lose. So to develop that winning habit that I talked about, it's much better to limit the time you have to trade. I personally trade from, and I didn't today because I had this presentation, Mondays from 8 o'clock in the morning Eastern time to noon. I do that Monday, Wednesday, and Friday. Those are my times trading. The rest I'm coaching others to trade. Okay, so I know that in my 4 hours of trading, I got to focus. I've got to be there for the chart, because I'm not trading before, I'm not trading after. The fact that I am there in a specific period of time that's unwavering, I will, for instance, when I trade on Wednesday, I'm going to be even more focused because I missed most of my trading day today. Okay, so the less time you have to trade, the more you're focused on doing the right thing. Very important. Okay, that's part of the habit of a professional trader. Okay, the common issue that I get with traders, and when I coach traders, I have them report to me their trades, and so I missed this trade. I missed a trade. Well, I don't know what. I went for coffee, or whatever it is. When you have a limited time to trade, you're not going to be missing trades. It's too costly. Too much waiting time leads to boredom and taking lesser probability trades. Just had somebody whose trade I reviewed for the first time, and he just admitted he's bored. I said, the good news is that you admitted that you're bored, and I applaud you for that. Most traders, the reason they continue to lose is they continue not to be honest with themselves. That was the good news. Now that was the good news. Now I'll give you further good news. Here's the way to turn that around, and I'll give them some way on in their mechanical way of trading, or I'll even give them a subconscious training that they can use to change their subconscious mind. I want to do everything I can, and I do that for traders that commit to me. I do all that I can to make sure that you're doing the right thing mentally and physically from the standpoint of what you're doing in responding to the chart. So too much waiting time leads to boredom, and you wind up taking lesser trades. You want to stick to the A+ trades. Okay, you really want to and you want to do it exclusively. Okay, you want listen. Good trading is all about putting the odds on your side. So moving to a lower time frame, I mentioned this, a 2-minute candle will not only expose more trading opportunities, but will also result in lower risk for trade. The candles are smaller primarily, and so your risks are lower. You can take on multiple contracts and still have the same risk exposure when you place your stop to fewer contracts, because you're working off a chart that is more friendly to a smaller risk, smaller candles, and therefore smaller risk. But the great thing about 2-minute candles against 5-minute candles, many times the huge moves, the big ones that happen, are captured just as well from a 2-minute candle chart than it is from a 5-minute. So you won't miss a lot of the grand opportunities likely, even though you're coming down to a smaller increment in your minutes per chart in the candle size. Again, you want to limit the time that you spend trading so that you can focus more. And if boredom is your thing, is a problem for you, and as I mentioned before, that patience is a huge problem with traders that I work with, and I can understand why. We can go into that at some other lecture, but the idea is that you can offset that by mechanically moving down in your time frame to expose more opportunities. Doesn't mean that you should be taking more trades just to take them, but if you can expose more A+ opportunities, hey, why not? And it also offsets a real issue with traders, and that's the lack of patience. So that's a very important key. I don't want to de-emphasize it in any way. It may look like a simple thing, but try it. As who's that commercial? Try it, you'll like it. All right, key 5. Do not trade against reports. This is, to me, it's an amazing thing that, I mean, I understand, and there are even traders who build trading plans specifically for taking advantage of um, of reports that are coming out, not all the time, not knowing which direction the market is going to move based on the report. Now, sometimes, as you know, the majority of the times, you get a pretty nice, a real jolt when the report comes out, and then boom, the market can whipsaw and reverse. So, in fact, I'm going to say most of the time, seems like that lately, but half the time it'll respond in one direction and completely go the other direction. Otherwise, other times it'll continue. The only processes that I've seen that I would ever coach on or recommend are processes in the option world that can minimize the risk of that volatility and yet capture. But I won't get into in futures trading. You almost got to be crazy in order to be, you got to be a real gambler, and you want to take as much of the gambling out as you can when you're trading. You want to go through, you want to rely on tested high probability actions, okay? So when you have a report that you don't know what the response is going to be, why should you be in the market? You shouldn't be, okay? The perfect example, it's a perfect example of a coin flip when you're supposed to be keeping the odds of winning on your side. Responsible winning, consistently winning trading is a matter of continually keeping the odds of winning on your side. At the beginning of the trade, by using a frequent, reliable A+ trigger, by managing the trade, by taking, as a prop trader, taking some of the quick profit that's assured to you for the most part, the majority of the time, with a frequent, reliable trigger, and then defending the running position, the running contract. You're and looking for ways to keep the odds on your side by reducing when the runner starts to run, reduce the time frame to 2 minutes so that you can defend even more closely. So you're constantly keeping the odds of preserving that open trade equity, of winning. And what is open trade equity? It's profit. You're protecting the profit that you were smart enough and disciplined enough to create. Don't give it away. Okay, so perfect example of a coin. There was a if I flip a coin, if I'm in a room and I flip a coin 9 times, and each time it comes up heads, first thing I would think is, hey, it's a weighted coin, but if it's not, if it's a coin that was out of your pocket and it comes up heads 9 times, what's going to happen? What's the probability of a tails the next time? Well, it's still 50-50, even though you're urged to think, well, it's got to be, you got to have a tail. It just had 9 heads in a row. No, each flip is 20-20. So even if you've had some success with betting against reports, having a position against a report, it's gonna catch up with you. Okay, that's not that kind of habit you want to create. Okay, most times leads to these reports will lead to the whipsawing action, as most traders initially overreact. And what happens is professional traders will key themselves in right away after a report. They seem to get it before we do, right? You look at, I'm looking at my clock, I'm looking at 8:30 and I'm looking at 8:29, and somehow, someone during 8:29, the market starts to move. Somebody's seeing it before 8:30, and I can see it on CNBC or whatever, it pops up. And so, you don't want to, you don't want to be the person left behind in a whipsaw. And what happens is when it starts to move, novice traders will get in thinking that they're getting in maybe fairly early on a big run, but those are the people that are going to be whipsawed into the reverse. Okay, if you wait until a new direction is clear, that new direction will also be defined. When I say defined, the direction is defined. It's a trend. Okay, so what happens in many times, and you can look at your charts in the past, look at the last Thursday, Friday, Wednesday, Thursday, Friday. I think the reports that came out certainly Thursday and Friday, and look at 8:30 and see what happened during that. Maybe it was Wednesday and Thursday, but look at what happened. You'll get many times you're going to get that whipsaw action, either partial or complete. But if you wait in say a 5-minute candle chart, if you wait till 8:45 or 8:50, even 9 o'clock. you're going to have enough candles there just to start to define what is really going on. And if you can get your frequent reliable trigger to fire, and you can do that in several ways, and again, I can show you to do that, then you can take a trade when the new direction is clear and eliminate the fray. Because in that whipsaw, you have a lot of people taking long positions and an equal number of people taking short positions, and a lot of them. When the market starts to trend in one direction, when the trend is defined, all of the people who were opposite that trend are losing more and more and more, and they will feed that trend by offsetting that position with the offset contract, okay, with the offset move. So if you understand what I'm saying, the losers feed the winners when a winner starts to run, okay? You don't want to be feeding anything, okay? You want to be part of the response, okay? This is what I'm talking about, putting the odds of winning on your side, okay? So I wanted to get to that key and give you a little time. This is the key number 6, which I cannot stress to this is the kind of chart I was shown. This is not exactly the chart, but it looks like it's got some pivot points. It's got some it's hard to see. It's a small chart up there, but it's got a bunch of trend lines. Looks like there's some Fibonacci raise there. I don't even see a tops or bottom trend line. It's got supports and resistance area defined by something, and even looks like it has, it's a mess, okay? How anybody can trade on this chart, I don't know. Even a serious professional trader like myself, I would never use a chart like this, okay? I'm going to show you a chart in a second that I do like to use, but I'm just saying to you that a simple trading plan will beat a complex trading plan every time. Not so much, I'm assuming that somebody who's running a chart like this has tested it and are waiting for a bunch of hoops to be jumped before they get in, and they know that if all of those hoops are jumped and they take the trade, they have a higher probability of winning than losing. I'm even assuming that. But there's a lot of crap that's built into this that can happen in between your ears, and that's waiting for that last shoe to stop, impatience, again, the potential for not having enough patience to let that last shoe drop so you get in early. And then when you miss it, you're chasing the trade. A simple trading plan will beat a complex trading plan every time. When there's too many hoops to jump, in order to make a trade, hesitation can often result. Okay, boy, that's enough. If you have 5 hoops to jump and 4 have already jumped and it's starting to move in the direction you want to, you start saying, hey, I'm losing some profit potential here, and I'm extending away from my where my stop is going to be. So God, I got to get in. So you start to do some things that you shouldn't be doing. Too many hoops can result in the market moving in your favor prior to getting in, resulting in a reduced profit potential while exposing greater risk. I think you all know what I'm talking about there. Why not have 2 hoops to jump? Okay, clear ones that are frequent. Okay, why not that? How about that? Because that works. Not only does it work as well as a tested trading plan that's as confusing as the one that you see, but also works from the standpoint, even better from a mental standpoint. It's very clear what you should be doing. There's nothing to wait for. All of these things are part of the formula to take you from struggle to winning. Simplicity lends to a sharper focus. Okay, those are 5 words that I think you need to absorb. Simplicity leads to a sharper focus. A simple trading plan is much easier to test as there are less permutations to consider. I ask ALEXA, I won't say it, otherwise I'm going to get excited, how to spell permutations. No, don't tell me. I didn't know, so I tried a couple of different, but that's the right spelling. Look, simple trading plans are much easier to test, and if you're not trading a tested trading plan, you're gambling again, okay? And if I tried to test this plan here up in the corner, there are so many parameters that I don't know that I would even get the more parameters that you have in a trading plan to test, the more likely it is that the testing will be inaccurate, okay? Because rules lead to other rules. A combination of rules lead to a certain effect. It's hard to explain, but because I've tested probably 1,000 trading plans, the more issues, the more things that you're asking the market to do, the more likely there'll be a complicated. It's almost like taking a drug and looking at the side effects. There are side effects to what you're doing. In any event, the bottom line is that you only have a couple of things to test. A simple trading plan is much easier to test, and that's the kind of trading plan that you want. Something that's tested and continues to be tested, rather than something that was such a pain to test the first time that you'll never test it again. You want something that where you're putting the odds on your side the vast majority of the time. This is simple beats complex. This is exactly the chart that I trade off of. And sometimes I don't even use one of the moving averages. This is the chart, and this is the chart that I trade on. Here is a particular frequent reliable trigger that we use, or it's hard to see it here. There's one here, there's one here, but you can see how frequent they come. This is a 5-minute chart. If I wanted more, I'd go to a 2. If I had something to do, but I still wanted, I'd go to a 10 and have a little bit more time between. So what I'm saying, I just wanted you to see what a simple chart looks like. Okay, this has RSI in the bottom. You can have MACD if you want, but I like some indicator. And I just like I like to trade price, and I like to trade price in some certain situations that I know are high probability to give me. And you can see how it gives you nice continuations, even at the bottom here. Okay, I just want to give you a summary now. We only have a few minutes left. I may actually have about 5 minutes at the end for questions if you have any. But in summary, successful trading is about putting the odds on your side. I don't know how many different ways I can say that. Employ a frequent, reliable trigger tested with a pop. Okay, I think I've drilled that into you. They're not easy to find. I have found them because I know how to test, but I'm saying that this is what I demand when I put together trading plans. Unless I used to put trading plans together for professional firms or trading plan. Each individual is different, so I'd find out what their weaknesses and strengths are and build a trading plan for them. But I will say that unless they ask me for a trading plan without a pop in the trigger, I'll include it. Initiate a trade with at least 2 contracts. 50% or more of your entries should be scalps, but leave room for a runner. I think we covered that pretty well today. The idea here is that I will mention that if I take on 5 contracts, 5 micros, or I take on 5, often I can even take on 4 or 5. I can take on 5 full euro-dollar Japanese yen contracts in the futures market in a $50,000 account. Sometimes my signal will be that effective. So in that situation where I can take on more. If I take on 5 positions, 5 contracts, I treat 3 as a scalp and 2 as runners. Okay, always preferring, always bending toward, always leaning into the scalping, because again, your primary purpose is a prop trade, especially in the beginning, before you can extend a funded account out $10,000 and $20,000 in profit. You're constantly, what you want to do is just stay away from that red line so you don't have to think about it. Always prefer, always initiate a trade with at least 2 and or more should be of the number of contracts should be scalps. Okay. The third is smaller positions with wider stops are preferred. I'd much rather give the market some room in upcoming markets. I'm kind of stressing that now. I don't think I had this on my last presentation, but I'm looking forward to much more volatile markets, and therefore you got to give them a wider space. Therefore, you got to take on less contracts and keep your stops a little bit wider. I can show you how to do that. Limit the time you spend trading. Again, the less time you have trading, the more you're going to be focused on doing the right thing. Okay, and again, I can help you depending on what your situation is. And of course, you don't want to trade against reports, because when you trade against a report, you're putting yourself in a 50-50 situation. It's actually worse than that, because I mean, if you had a smooth market and you took on a contract without any reports around, you know, it can move slowly in your direction, and yeah, why did I do that? You can slap yourself in the face. But when you're in a report, you're not only in a 50-50 situation, but it can go dramatically against you just as much as you can go dramatically for you. In fact, if it goes dramatically for you, you tend to want to stay in and get more, which will lead you to the whipsaw and giving away open trade equity. So as a prop trader, it is not, you shouldn't allow it of yourself, okay? So don't trade against reports. And a simple trading plan beats a complex trading plan every time, okay? And I'm going to say that. I mean, again, I'm going now. You can show me a complex trading plan that the statistics show that it would have been profitable 75% of the time, not 72% of the time, and therefore it's a better trading plan. Well, from that parameter, I would probably agree with you. But what you're not considering is the human parameter of running a trading plan like that. If you can't take responsible trades because there's too much confusion on your chart, or you're waiting for another shoe to drop, you know, listen, I don't even use a volume indicator. All right, shoot me. Because to me, if I have a large candle, part of my triggers involves large candles. When you have a large candle, especially after a series of small candles, I don't have to look at the volume. I know that I'm having an increased volume. Okay, so the way I trade, it's a parameter that I don't need to see because it's already part of the size of the particular candle that I'm looking at as part of my trigger. So I don't need an RSI and I don't need a moment. I don't need a backday. I don't need both. Okay, I choose one. I chose the RSI because I'm a fan of a woman called Hema Reddy. And she has taught me, if you don't know Hema, look her up. She's got some good freebies on the use of RSI. She's a genius in that area. So again, simple trading plans beats a complex trading plan every time. And I want to give you, this is my offer to you, and it's not really, it's a request really. I'm coming out with a book in January called Their Money, Your Profit, cashing in on the prop trading revolution. It's in its final stages of development. It's due out in January, but I want to amass 50 to 100 case studies, those that have followed some of the things that I'm talking about in the book and have succeeded and given me some testimonials before the book comes out so I can include it in the book. Okay, so this is the Loaded Gun Simple Trading Plan case study group that I've already started putting together 2 weeks ago. It's going very, very well. But I'd like as many people as I can in this case study group. And the promise of the case study group is am I still sharing? Yes. The promise of the case study group is the evaluation, getting through the evaluation stage, the funded stage, and the money wired stage. Actually, money wired from Apex or whatever firm you're using into your account. I want to get money. Once you see money in your account, that changes everything. When I first got it in prop trading, I said to myself, is this real? Is this true that they're giving me tens of thousands, hundreds of thousands to trade? Because I've got 12 funded accounts now. So if I'm trading over $1 million in funded accounts, how can they do that? How can they? And when I first got the first, I think it was $1,000 I asked for, and then 2,000 after that, I called the bank. I said, "Is this real?" Yes, this is real. It's real. It's real for the consistent, disciplined trader that's doing the right thing, especially by open trade equity. Okay. Sorry about that. Let's put that in. So I want to get you from the evaluation funded. I want money in your account. And right now, there's enough trading days to actually do this for a moderately experienced trader before the end of the year. So I want the case study group. And for me to help you with this, what I'm asking for you is of course the fee to do this, but also the one-on-one coaching that is involved here. But also I want the testimonial from you. That's really why I'm doing this. Why I've made this very attractive for you to do this with me. All you have to do is just write me at admin@thedisciplinedtrader.com. Okay, and just put in the subject line or in the body, I'm interested in the case study group, and I will send you a PDF explaining. It's a 3-page PDF that explains what this case study group is and how you can get involved, how you can have me help you with putting with getting money wired into your account, especially before the end of the year. But if you're a newer trader, maybe it's going to take you through the middle of January or the end, but it really shouldn't take you any more than that. We're going to be dealing with one or two $50,000 accounts to start with. I just want to get that money in your account so that you can feel it and you can really get inspired that this is a real thing. So if you're interested in being in the Loaded Gun Simple Trading Plan case study group to supply me with testimonials from my book, upcoming book, just write me at admin@thedisciplinedtrader.com and ask for, just say I'm interested in the case study group, and I will respond by attaching a PDF so that you can take a look at what it's about. I'd love to have you. The more traders, the better. The more more testimonials I have, the better. Anyway, Alyssa, if there's any questions, I don't see much in the chat. I see that we've put the thank you, admin@thedisciplinedtrader.com in the chat. And if there's no other questions, I will end here and look forward to you joining me in the case study group. And let me show you how to keep that equity that you're building in your account, especially if you're struggling as a prop trader. Really, come on, let's get this done. Let's get it going. So anyway, that is it for me, David. I appreciate the opportunity to share what I've experienced with you today.